Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the top 10 best stocks to buy. Now, surprisingly, Jim Cramer actually handpicked these top 10 best stocks to have in your portfolio to prevent you from losing money during a recession or even potentially making money. And normally, I don't agree with a lot of advice that Jim Cramer gives. However, these particular stocks, I actually think that he did a pretty great job. So I don't want to throw the baby out with the bathwater because these particular stocks have fantastic growth trajectories and the companies that they represent have very good fundamentals. So for more videos like this one about the best stocks to buy during a stock market recession or even before a recession, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's just jump right into today's stories. So these businesses are not in any particular order. I personally like the majority of the companies that are on this list, and I will give my own personal opinions on them after we go over a quick overview of what they do. So we're going to start off with our first company, which is Micron Technology Inc., ticker symbol MU. Right now, the MU stock price is trading for around $62 per share, and we have price targets that range anywhere between $50 to $110 over the next 12 months. Right now, Jim Cramer thinks that the stock is going to rally up to around $70 per share because recently the company announced that they are going to begin production on the world's first 232 layered NAND, or NAND. And if you didn't know, a NAND or an NAND is basically flash memory, and it's a type of non-volatile storage technology that can retain its data and it doesn't require power. So this is very innovative. Apparently, it's going to be one of the highest capacity NANDs, and it's also going to be extremely energy efficient. So it's literally designed for both client and cloud applications. If you didn't know, Micron Technology Inc. as a whole offers a plethora of various memory and storage solutions, and that's why I personally really like this company. If we look over what UBS analysts have to say about the MU stock price, they think that the stock price is going to surge up to $90 per share because that's their price target for this particular company. Moving right along, we have DR Horton Inc., ticker symbol DHI, which currently trades for $75 per share, and our price predictions among experts say that the company is worth anywhere between $70 to $120. This company is a leading home building company that operates in the United States in around 33 states where they either acquire or develop land. DR Horton Inc. has a 12-month trailing PE ratio, or price to earnings ratio, of just 5.04, and ideally we would want the PE ratio to be as low as possible, particularly below 15 would be pretty ideal for a company like this, and I would say a PE ratio coming in at around 5.04 is absolutely fantastic. And they also offer a forward dividend yield of 1.16%, so you are not only going to get a fantastic company that could keep your portfolio above water during an economic recession, but it also offers you a dividend yield, so it gives you that free cash flow as well. They recently released earnings for the fiscal third quarter of 2022, and the company brought in revenues of around $8.79 billion for the quarter, which would represent a 20.64% year-over-year increase. On top of that, they beat Wall Street's estimates and expectations for their earnings per share by around 15 cents because it came in at around $4.67 for their EPS. This is so impressive that a Citigroup analyst actually increased his price target for DR Horton Inc. to $90 from the original $73, and he reiterated his buy rating. So overall, this is another fantastic company that you could keep in your portfolio that would be great during a stock market crash or an economic recession. The next company we have is Amazon, ticker symbol AMZN. And Amazon's share price right now trades at $140 per share, while professionals think that the company is worth anywhere between $110 on the low end and $232 on the high end. They also recently reported their earnings for the second fiscal quarter of 2022, and they reported a loss per share of 20 cents, which actually missed their estimates by 32 cents. The revenue for the quarter came in at around $121.23 billion, which is an increase of around 7.21%, and it beat Wall Street's projections by around $2.09 billion. So overall, we have a mixed basket here. But despite that, I do think that their advertising and cloud business is doing extremely well, and a JP Morgan analyst has identified and actually actually raised his price target for Amazon's AMZN share price from $175 up to $185. So overall, I think this is a very strong buying opportunity for investors to jump on Amazon right now. The next company we have is ticker symbol PXD, and the company is named Pioneer Natural Resources Company, and it currently trades for $220 per share, while price predictions range anywhere between $190 to $422. This company operates as an independent oil and gas exploration and production company in the United States. They have a decently impressive trailing 12-month PE ratio of 14.1, which is not that bad because it is coming in below a 15 PE ratio, which is going to be ideal for the stocks mentioned on this list, and they have a very impressive dividend yield of 5.45%. So this is going to be a great company to buy if you want passive income or if you are a dividend investor, because dividends are going to come in handy during a stock market crash or a recession because it gives you as an investor some cash flow, some passive income. Speaking of cash flow, the company's free cash flows came in at around $4.64 billion. And according to Goldman Sachs, this company is one of the top energy stocks to buy right now. And this analyst also anticipates that in the future, it could increase its dividend to $8.24 per share. So this is absolutely phenomenal, and that would equate to around a 15% dividend yield. We also have another analyst from Raymond James who has a strong buy rating on this stock. However, he did decrease his price target from $375 down to $315. But overall, I think this is an extremely strong company to buy, especially if you anticipate an economic recession. The next business on our list is Dollar General Corporation, ticker symbol DG, which currently trades for $250 per share, and stock experts think that the company is worth anywhere between $199 to $285 per share. This company has received extremely strong sales volume, particularly during tough economic times or times during economic or stock market volatility. The company also offers a decent forward dividend yield of 0.9%, and they have free cash flows coming in at around $1.53 billion. Wall Street analysts are particularly very bullish when it comes to Dollar General Corporation, and an analyst has even raised his price target for the company from $240 up to $275, while he reiterated his outperform rating for this particular company. Now, Dollar General, in my personal opinion, is a decent company to hold, but I do think there are better companies on this particular list that deserve your capital more. I would just keep this in the back of your mind, or at minimum, put it on a watch list. Now we're breaking into our top 5, and this is one of my favorite energy companies, and it's Coterra Energy, ticker symbol CTRA, which has a share price of $28, while analysts think that the company is worth anywhere between $26 and $46 per share. The company also offers a decent dividend yield of 1.95. This company, if you didn't know, is an independent oil and gas company that engages in the development, exploration, and production of oil, natural gas, and natural gas liquids, and they are mainly operating in the United States. Normally, stock professionals have higher end price targets for this company, which range anywhere between $40 to $46 on the higher end, and I think that's what the company is really worth. Considering that they also have a decent dividend yield, this could be a fantastic growth dividend stock to own. The next company we have is similar to Dollar General, except this one is Dollar Tree, ticker symbol DLTR. They have a share price of $163 per share, while investors think that the company is worth anywhere between $110 on the bearish end and $206 on the bullish end. This company is a leading discount store retailer in the United States, just like Dollar General, and they operate around 15,500 stores across 48 US states. A Truist analyst even commented that this company is undervalued right now because he believes that the company is worth at minimum $178, which is his personal price target. Likewise, we have a UBS analyst who also named this stock in one of their high conviction plays, and he has a personal stock price target of $185 and believes that this company could do phenomenal during a recession. And I actually tend to agree. When a recession comes, companies like Walmart, Dollar Tree, Dollar General, and companies that can sell products at a substantial discount compared to their competition normally do very well during economic uncertainty. The next company we're going to talk about is Constellation Brands, ticker symbol STZ. This company trades at $243 per share, with estimates coming in for their price target from $240 on the low end to $300 $315 on the high end, so potentially this company is almost undervalued according to professionals. This particular company produces, imports, markets, and sells alcoholic beverages, which would include beer, wine, and various spirits. And they do this in the United States, Canada, Mexico, New Zealand, and Italy. Wall Street is actually very positive and bullish when it comes to this particular company, so much so that a Barclays analyst raised her price target for the company from $272 to $281 per share. The analyst went on to cite how the company has fantastic fundamentals and could be a solid buying opportunity for investors. Likewise, a Redburn analyst also has a buy rating for this particular company because the company is not only a fantastic future growth company, but it also offers a decent dividend yield of 1.3%. Number 2 on our list is actually Johnson & Johnson, and of course this is one of the blue chip stable companies that I think should be in everyone's portfolio, with companies like Procter & Gamble and Coca-Cola. These companies are not growth companies, however, they have fantastic value, they're extremely stable, they're blue chip stocks, and Johnson & Johnson in particular is a defensive stock because it's in the healthcare sector. Right now, Johnson & Johnson, ticker symbol JNJ, trades for $170 per share, while stock professionals think that the company is worth anywhere between $165 to $215 per share. The company has very predictable growth, and they have a future dividend yield of 2.61%. In the fiscal quarter of 2022, the company actually reported earnings per share of $2.59, which beat Wall Street's expectations by around 4 cents per share. The company also brought in revenue of $24.02 billion, which beat Wall Street's forecasts by almost $200 million. An SVB securities analyst revised his price target for Johnson & Johnson recently down from $200 to now the price target is $194. However, he still reiterated a buy rating for this particular healthcare company. Lastly, but not least, we have a beverage company, which is Pepsi, ticker symbol PEP, which trades for $173 per share, while stock experts think that the company is worth anywhere between $160 at minimum and $200 at maximum. The forward dividend yield for the company is pretty strong, coming in at 2.68%, while the company has a 12-month trailing free cash flows of $6.33 billion. A Morgan Stanley analyst even adjusted their price target for Pepsi from $186 down to $185. However, he reiterated a buy rating for the company and says that this company could be a very favorable investment during, before, or even after an economic recession. The analyst also went on to note that the risk to reward ratio of investing into PepsiCo is clearly favorable more to the reward side. Lastly, a Morgan Stanley analyst also chimed in and reiterated his overweight rating for this company, and he has a price target of $198 per share. So overall, I think these are some of the best stocks that investors could buy, especially if they are thinking that a stock market crash is coming or an economic recession, or potentially even both. So as always, make sure to do your own research on these companies, make sure that these align with your personal risk tolerance and your investing strategies. Subscribe if you are new, smash that like button for more videos just like this one, and I will see you in the next YT video.